Hello, YouTube. Is the stock market crash canceled? We're going to talk about one simple indicator which could tell us that maybe this is shifting. Jerome Powell spoke today and he avoided talking about U.S. monetary policy. So maybe he blanked. That's the big question for today. All right, let's talk about the one indicator we're looking at here. We're talking about the 50-day moving average, and we finally got a daily candle close above it. As a reminder, when we get two daily candle closes over a moving average, or sorry, any close above a moving averages, weekly, monthly, daily, I consider two to be a potential trend change. So if there's a potential trend change happening where we are currently going down, going sideways, and starting to go back up, could we go back up to 400 or higher? Yes. Is it my base case? Is it likely? That's what we're going to discuss today. So let's talk about one more simple indicator here, and it's just looking at the Friday high, and then also looking here at our 50 DMA, which was just above right at 390 today, basically. So we're going to look here at the white line, which goes back to our June gap. That's the June 10th gap, and then we also have the Friday high at 38925. So now let's go look at our 15-minute chart. Let's see where today started. Let's go to regular trading, and now we note here that today's open is right here, 930. What do we do? Well, right at the open, I was watching this so close. We hit that green line, which we just showed you where it comes from, 38925. We hit it. We backed off. We built up pressure. We got over it. We lost it, printed a lower low on the day, and then started melting higher. And we actually claimed and held it into the close, which means that we actually have back tested and passed that Friday high. And we also closed above the 50 DMA. This signals a potential trend change for me, as I just noted. So what I really want to focus on today is the SP 500, because what is happening here? Well, we got a doji on the weekly. We opened at 390.37. We're sitting here at 390.58, or within 20 cents of each other. And before I forget, if you could do me a huge favor, please and thank you. If you could please smash that thumbs up, I would greatly appreciate it. There's currently some issues with YouTube views. We always appreciate you guys being here. And again, that thumbs up just really goes a long way to support the channel. Anyways, with a doji on the weekly post Jerome, when I thought we were going to get a 10-point move, why did we not move more? Well, let's read his comments. Jerome Powell does not comment on current U.S. economic or monetary policy outlook and prepared remarks for Sweden's symposium on central banks' independence. Restoring price stability when inflation is high requires measures not popular in short term. It kind of looks like he blinked here, right? He winked last time. Now it maybe looks like he's blinking. We've been hearing discussions about a 25 basis point hike. He did not really walk it back. Cool. Next time we hear from the Fed is going to be on February 1st, which is 3 weeks, which means we're looking for 3 more candles. As a reminder, yesterday we talked about QQQ and 273.3, which comes from our 50 monthly moving average. So we have now poked above it and we're trying to claim it. That is the first big test. We got to get over this 50 monthly, and then we got to get over the 50 daily. I'll show you that level here. It's currently at about 277. And then on the weekly chart, which is the one we're looking at for a perspective here, it aligns at roughly 280 here. We also have that going back here to our May low. So if we're going to start reversing, it's very clear to me what we need to see. And when I look across a lot of these different charts, let's just quickly go through for a couple of seconds here. So stuck between the 50 and 200. I'm just going to go through here below both. So it's really tech that's lagging. On the dollar, we're below, which means there might be a trend change here or losing that uptrend. Right? We might actually lose this uptrend and start going down, which would be supportive of stocks. On the VIX, well, it's back at 20. Can't seem to hold it. Why? As I mentioned before, this recession and this move down has been talked about, telegraphed, beaten to death. Everyone's worried. Well, what's left? Right? We went to the fear. Now we're back to neutral, right at 50, which means we're either going to get a push into fear or a push into greed. I'm just trying to be receptive to what the charts are telling me. I'm not really focused on being right. I'd rather just make money. That's my goal. Looking to the 2 and 10-year note, this is where it's a little bit contradictory because we stopped going up. We're green on the day. We're red on the week. Anyways, moving forward, same thing for the 10-year. 10-year is going higher, so that's giving us a signal. But let's jump down here to the ETFs because what do we know? Well, over the 50. DIA, over the 50, green on the week. RSP, over the 50, green on the week. NYA, over the 50, green on the week. IWM, battling for the 200 small caps and looking for the 2018 and 2020 highs as before. Nothing's really changed here. XLF, over the 50, green on the week. XLV, red, A little bit, green on the week. Looking here to XLE, green on the week, over the 50. Nice. Looking here to XLU, green on the week, over the 50. XLK, stuck, right? That's technology. Looking here to ARC. Whoa, ARC is up 7% this week alone. Yes. Again, high growth, getting a high bid. It's way in the dumps too, though. FXI, green in the week, over the 50. EEM, green in the week, over the 50. Now let's look at the DAX, which is Germany. Green in the week, over the 50. It looks like if these tech stinkers can finally start catching a bid, maybe we're going to go higher. So if you wouldn't mind, please smashing that thumbs up. I would really, really appreciate it. Let's go through a few more things here and understand the reason why this might be happening. If there is a global boom happening for 1 month, 2 months, maybe even more, might even be 6 months, we have to be receptive to it. And when I look here to a note from Goldman Sachs today, they're talking about how the euro area will avoid a recession. We no longer look for a euro area recession reflecting better growth momentum, sharply lower natural gas prices, and earlier China reopening. We upgrade our euro area forecast to 0.6 for 2023 from negative 0.1, now notably above consensus. So if stinky Germany and stinky Europe is what? Is up 6% on the year, is closer to its all-time highs than not. It is over the 2020 high. It is above the 2022 close. Whoa, wasn't Europe the area everyone's scared about? Isn't that where those countries fighting right now? Isn't there supposed to be a deep, dark winter? Isn't there supposed to be more rate hikes coming in ECB? Well, the market doesn't seem to care. So if this region can do well, and emerging markets are doing well, China's doing well, the US is the laggard. Oh, the US is the laggard. So if that same story plays through to America, right, America, that we heard about for the rest of the world, where maybe recession's not going to happen. We talked about this before too. I showed you on the GDP now where it looks like it might be less likely. So let's be receptive to it. We're now right back here in neutral, which means that, again, the bear narrative is like the dominant narrative now. There's something called the recency bias where when people are looking at the charts, they're like, man, who doesn't know we're in a bear market? Who doesn't know we've been going down for a year? Nobody. So who's left to sell? Who's left to short it? That's part of what I'm trying to wonder. I don't know. I've been very receptive to the bear market, but when you're a contrarian and you're getting early feedback is where you make the biggest gains. This is no longer a contrarian view that we're going to be going lower. It's now consensus. So I believe that there is potential for us to rally up, not only right now, not only into the 20th when we have OPEX, not only into the Fed on the February 1st, which is when we meet the next boss. We climb the wall of worry, right? We climb the wall of worry, and then there's nothing to worry about. So the people who are not willing or not able to hold through for those periods of volatility, when we get to the top, they're like, oh man, I missed out on those great bargains down here at the bottom. You want to buy fear and sell greed. And right now, we're right back here in neutral. So if this number comes in at 6.5 on Thursday, I think it's going to be bullish. Am I 100% confident in that? Well, I think I told you earlier that I've now flipped to being a net long, which means that I'm actually long the market now. I'm flipping to net long. Am I all in? Do I have more buys planned? Am I going to hedge? Well, that's why you can join me, Justin from YouTube, to see exactly what I'm doing. But I am seeing the potential for a bull narrative building. We talked about the 50 DMA. I'll show you one more indicator or one more pattern that I'm watching. And it's just forming higher highs. So we got the higher lows, which means that bulls are willing to defend when the price comes down, but now they're also willing to advance the price. Why? High, higher high, and higher high. And on the weekend, we talked about how is Jerome Powell going to drag us higher? Well, he didn't hurt us, and that seems like a really big win right now. So the very last thing we're going to look at today is going to be looking here to the heat map. And I'm noticing that there is clear rotation happening. Energy, healthcare, those were the things that were just relentless last year. Now the big focus is going to be here on tech and the rest of the market to see whether or not it's able to drag the S&P higher, because tech is the biggest component in the market, but it's still only about 25%. So if tech can just go sideways, if not a little bit up, that might be all it takes for us to go higher. So thank you for watching. I look forward to seeing you tomorrow. Thank you so much.